Hi, and welcome to this morning's early global view. It's currently 6:45 a.m. U.S. Central Time on Tuesday, February 23rd, 2016. And as far as the data, it's still weak. As a matter of fact, we put up a post last Friday that's only been reinforced into the top of this week on is abysmal news good news for the equities, of course, and it would seem to be the case. So we need to ask, what has all this meant to the markets? Well, looking at S&P 500 that gapped up yesterday, and this was very interesting. We'll get back to the technical indications in a moment. It's off just a couple today, pardon me, at 1934. It has ranged down as low as 1925 this morning. But as you can see, that 1925 was the old low end of the 1925 to 32 resistance. It barely pushed up into last week, Wednesday and Thursday, before rolling over a bit Thursday and seeming, pardon me, to weaken. And along the way on Thursday, it left a down break from 1922. Now, this could have offered a sign the market was running out of gas, except, again, we're in the psychology now where bad news is good news because of the previous normalcy bias, the degree to which the Fed is trying to convince everybody that things are going back to normal and has signaled repeatedly that it wants to raise rates. So the worse the data gets, the more people assume that the Fed might not be raising rates. So some really follow-on nasty data from overseas Monday morning left the market higher, along with some improvement in the oil price. Of course, that encouraged it. And by gapping back above 1922 and overall the 1925 to 32 area, as a matter of fact, left the low of the day at 32.5 yesterday, it reinforces all this as support, with next resistances up into about 1950, then 1958 to 62, and ultimately 1970 to 75 area. So those are your higher resistances. If it should roll back down below 1922, then you'd be looking at lower support, as we saw on the pullback on Thursday, back into the 1902 to 1895 area and lower. And that pretty much does it for the short-term view of the S&P, except to note that the sideways churn yesterday did not really put the hourly MACD back below its upper runaway band, and that's kind of important because having dipped a bit this morning, it could even dip for a little while today, but unless it's more convincingly back below that 1925 low end of the old congestion area and the 1922 negated down break that is additional support now, it probably is okay for a push up to those higher resistances in the current circumstances. And that pretty much does it for the short-term view of the S&P 500.